Hi, welcome to this episode of Industry Voice. Today I have Joey Liner. How are you, Joey?
I'm doing well. Thanks for having me, Jeff.
All right, audience. Joey is OG. This show is about bringing on OGs, and Joey is the OG of the performance marketing world. And Joey just a guy who been through a lot, knows a lot, and everybody in the lead gen industry knows Joey. So, Joey, I'm not gonna steal your thunder. I am gonna let you do your own intro and tell the audience who you are.
Oh, thanks again for having me, Jeff. I'm excited for you to launch your show. I've great admiration for friends and colleagues and peers that want to put out some great content out there. And it's clear, even in the election, that podcasts have made this just a big difference in success of the candidate that won, right? And so, not saying that the candidate that lost didn't do enough podcasts, but maybe the audience, audience targeting was clear. That Trump went through and got and pulled through success for the people that he really wanted to make sure he secured votes. My
Yeah.
background is in performance marketing. So I've been in the performance marketing space for 22 years. I started back in the early stages of the first refinance.com wave, coming out of the stock market kind of bubble from the dot-com era in 2000s, and then the refi wave 2003, 2004, and built out a company called Double Positive, which was focused on warm call transfers, getting consumers on the line, verifying that they're a good candidate, speak to a mortgage company, and transfer them to a mortgage broker. And that business evolved basically because we were selling digital leads, mortgage leads, and we had heard from our clients that they were just struggling to get the consumer on the phone. And so, kind of my partner and I, Sean Fenlon, who I think we built out the business together.
Shout out to Sean.
Yes. And it was really just it was exciting, up until the financial crisis, because we were all in mortgage. And the financial crisis kicked us in the gut, and just like everybody. And we went from a $10 million run rate to less than a million overnight, and it was all of our big clients had to shut down, and so we quickly pivoted because we wanted to keep the business going, and we love the call center space. We got into education, online education, because at that point, once the economy took a big hit, people wanted to go back to school. That was a big lead generation channel for consumers that were, uh, looking to enroll in some of these schools. They were doing aggressive advertising, so the government had to jump in there and regulate that. But we got into, rightfully so, we got into education, and then we also got into insurance. And great story about that too is Brian Uckletree, who was a also a management team member of Double Positive, had a vision to build out Lead Cloud, and he was able to execute that under the Double Positive umbrella ultimately, and spun that business off to, of course, being very successful and had multiple exits today in the last decade, but Lead Cloud was really Brian running and learning so much about auto insurance that he really helped us stand up that vertical at Double Positive and build out direct relationships. So we had grown out education, insurance. I stayed on that business, sold in 2016. I stayed on as one of the last remaining founders, and then I joined Digital Media Solutions in 2000, at the end of 2018, going into 19 as the chief revenue officer. And for me, that was an excellent experience, just being able to go from managed services, call center services, to now being behind media and lead generation and affiliate and pay per call and all these different businesses that DMS had kind of had strived either through organic growth or acquisition. And so I'd been through and saw a bunch of acquisitions come through DMS. We saw the business go from 100 million to 400 million over the course of a couple years. Went SPAC in summer of 2020, like a lot of companies during pandemic. That was a fast track to an IPO, not traditional underwriting. And unfortunately, that initially it seemed okay. Auto insurance was our primary business line. just like a lot of other folks in the lead generation space, like Lending Tree and Media Alpha, Quinn Street, to name a few that were public. And unfortunately, we once the Q1 of 2021, the decline hit, with obviously the carriers starting to pull back because people were driving again, the loss ratios were starting to come out of line. The stock just cratered, and it just continuously went downhill. Fortunately, the financial structure of the business just not there, and then obviously analysts and investors did not want to put more into it, and so I left midway through 2022 and started my own consulting business called Liner Connections, which just focuses on connecting buyers, sellers, service providers inside the performance marketing space, focusing on direct to consumer customer acquisition, which I've been doing for like all these verticals for 22 years. I also do work in some recruiting, which has been really cool, helping people find their next big gig. That's something I never thought I would do, but just made sense based on my Rolodex and connections within the community. So I've placed a couple people this year, which has been great. I'm an advisor on a couple boards. I've had a lot of fun being on my own. And what's really fulfilling for me is when I really see a connection, whether it's $1 million revenue deal and I just connected these two parties, right? Or placing this executive in this new role, and then just seeing, knowing that I was responsible for that and changed that person's life. It's super rewarding. Obviously, the financial part of it's great, but just the gratification of seeing somebody happy and knowing that they're going to be successful and both parties are happy. So Liner Connections continues to grow, and it's been fun.
Going from corporate world, being a public traded company, quarterly earning calls to be on your own, this big pivot.
Oh, it's huge. I mean, when I can say going through the pressure, and this is for a lot of my friends that continue to work for publicly traded companies, I have the utmost respect and admiration. The deadlines that you're required to hit in today's world, based on the requirements um, by the regulatory boards or governance, it's tough. It's a lot of pressure, and you have to focus on running the business and continuing to be successful in your day-to-day roles and responsibilities for you and your team, and then you still have to make sure you hit all these requirements for reporting, and a lot of them obviously are important for safeguarding and making sure that there's compliance and businesses are operating properly. But it's a lot of pressure. It's a lot of pressure. And it's okay when your stock's going up because you get to reap the rewards and you're seeing that, but it hurts when your stock's going down. It's a lot of pressure on everybody, extra pressure, and it's the morale. It's hard when you see that stock going down because everybody's working hard on those deadlines.
The last 5 years, we saw some major change in the Medicare world.
Yeah.
And then 3 years ago, the major change in the auto insurance world, especially in the lead gen world. And we're about to go through another one with January TCPA that's coming. How do you think it's going to change? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
Like you said, there's different cyclical changes, whether it's or cyclicality, obviously macroeconomic trends like mortgage rates rising, dropping, people loss ratios for auto insurance. That over time, verticals have bursts with just, macroeconomic trends. Then there's like regulations, right? CMS for specifically for Medicare, monitoring ads, making sure that obviously they're not being deceptive for seniors and not offering benefits that, are are really false and companies can't back them up. Unfortunately, in performance marketing, what I've found over the last 20 some years is when the macroeconomic trends favor growth in a vertical, affiliates or publishers pounce on that in the sense of it's just gasoline on the fire. How much can we penetrate within there before we get our hand slapped, right? Because it's like, we're going to just make a ton of money in this category until somebody does, shut it down. And so it's whether it's greed, whether it's just selfishness or just pure, some folks feel like that's the way they want to operate. That's just the reality. It's just how things have played out in performance marketing lead generation. It's like, I guess if you don't do it, somebody else is going to do it, right? And then people just were like, well, I want to do that, and I want to get in that $1 million run real quick, or $5 million run. And unfortunately, it's every industry that goes through major growth in digital ads, there is usually some sort of regulatory board, even within that specific category: auto insurance, mortgage, Medicare, right? But now we're looking at this federal change, which has happened before over my 20 some years too. So there's a federal rule that's going to go into effect January 26th, which is requiring one-to-one consent. And why did we get here? Because, well, in 2004, there was one of the first things that I lived through was the do not call list, right? Like, that was when everybody had home phones and that big fat caller ID that you'd stare at, and it's because we were, consumers were just getting solicited everywhere and at home, mainly just being bothered around the clock. That worked for a little bit, for DNC, but then ultimately cell phones evolved, right? And then cell phones, people had, the beginning of cell phones, you were paying per minute. That was the starting phase. So you were getting unwanted texts or calls on your phone and you had to pay for it. So just like, unfortunately, a lot of things within our government, it takes years to catch up on regulation. So in 2013, they built a rule that basically said, you have to have express written consent, the mobile provision of the Telephone Consumer Protection Act. By that point, all the carriers had all you can eat phone plans, right? But it's still, you don't want unwanted calls. You want it clear to, I'm opting in saying you can call this. Well, that was a big deal in lead generation because in the past on digital ads, you would put disclaimers in like the privacy policy, at the bottom of the page, or there'd be a link out for it. In 2013, that was when the first time lead generators started putting clear language by the submit button that said, hey, by clicking here, you are authorizing to contact me via automated dialing technology, text messaging, voice broadcasting. And that was by the submit button. Now, they didn't list the entities that we're going to call. They put a link out to what's called a marketing partners page and said, and then that page started building out brands. And over the last decade, some of these pages from the performance marketing lead generators have thousands, tens of thousands of names that they just accumulated. So anybody on that list essentially can call them. And so the FCC over the last couple of years reviewed that and is getting obviously a lot of complaints. There's the consumer protection bureaus that kind of have lobbyists from TCPA plaintiffs and counsels that have every they want to continue to see more settlements, right? They want to see more money coming in their pockets. And so they're now they put this rule in place for January, which is saying it's clear one-to-one consent. Now, what does that mean? A lot of folks are interpreting that as you have to list the brand that is going to be calling the consumer and making sure that the consumer has said, I want to speak to ABC. I want to speak to XYZ, right? And whether that's a checkbox or whether that's an exclusive lead, you can maybe list multiple buyers, but does the buyer have to check each box next to the brand, or can it all be selected, or is there a select all button? That's what's kind of been up for debate the last couple months and weeks as we get closer to the deadline, which is, like I said, January 26th.
You see this deadline being extended?
Not right now. I don't think it will be extended because they did open a public comment period a couple times. And I think there are some people that are hopeful that they'll be extended. There's a chance. I mean, there's always a chance because there's a couple things. There's I don't think the FCC did proper analysis of how this has impacted small businesses. And so there is a fight from the Small Business Association, and rightfully so, right? Because if you think about the scenario I just talked about, if you go through the check boxes, right, you list all the brands. Let's say you see 3 national brands and then 1 small regional brand, right, or small local brand. What's the consumer going to choose, right? If they have to choose who they want to speak to, they'll probably choose the national brands. They've seen the TV commercials. It's a household name. Well, that small business just got screwed, right? Because they want to compete too. They may have the best rate, but the consumer doesn't know who they are, so they didn't check that box. So this kind of like, I think that's a big flaw in the rule. And I also think that small businesses rely on automated dialing technology to be more efficient, right? Rightfully so, right? They're a small business and they don't have the infrastructure or the budget or the staffing. So I think it's okay in some instances if you're calling somebody who's asked to be called to use automated dialing technology or SMS, right? So I do think that there is a chance that the Small Business Association is able to continue to work with the FCC on some things. Doesn't necessarily mean that the rule is going to change, but it does think that there's continuous effort to work through. Obviously, the election has a big impact. We'll have to see how that plays out, which doesn't mean the FCC will turn over once Trump appoints all of his. So that means the majority on the FCC will go back to Republican, and there'll be a new chairperson. Now, typically, and I've learned this from other attorneys that have experience in changeover administrations, is when there is going to be changeover administration, the current group scrambles to get everything pushed through, right? Because they know they're about to get fired. So that's why I also think at this point it's going to be in place because the current commissioners know they're going to be gone, and they're going to make sure all the work that they just did over the last 3-4 years is going to get put into place before they leave.
In a way, they're trying to protect consumer from being called by 30 people, but at the same time, consumer now going to have a way less shopping options when they only get called by one company for price comparisons.
Yeah, I mean, look, has our space has it gotten out of hand with communications? Absolutely. I mean, but we've gone from extreme, like to your point, we went from probably a long list of folks that could call or text or email and data brokering and warm transfers. Like, yeah, it just became way too much. And then because unfortunately, I think a lot of that spurs from publicly traded companies forcing to monetize their data, right? To hit their goals, right? It just try to grow, you're under that pressure, right? So I'm not blaming one specific entity. I think it's just the trend, that space, that everybody was forced to do more revenue, and you lose track of how the consumer experience should happen, right? You start treating consumers truly like numbers, zeros and ones, and not, hey, if I was to go through that, or my mom was to go through that Medicare flow, how would I want her to be treated, right? Like we lost track of that going through. We put up cool ads as a space. We put up, a lot of different channels, Facebook, Instagram, TikTok, et cetera. But did we actually realize how this consumer was going to go through that flow? And what was that experience, right? So I think we lost that as a space, and I think we're going to be forced to recapture that here. But you're right. Does the consumer lose out on if we just match it to one brand, because the lead generator is really scared that if they introduce multiple brands and they don't do it the right way, well, what if that brand that gets matched to that consumer charges at a crazy rate because they had to pay now, instead of paying $20 lead, they pay at 100, right? So now they're like, oh, well, I have to raise my fees now to make this a profitable cost per acquisition. So there are flaws for sure in the system. And that's the problem with I think, in my opinion, our society is we go from extremes. We can't find rational, rules that make in business that make sense. And I think that this would have been, hey, you can only call this consumer X amount of times over X amount of days, and it can only be sold X amount of times. Like there were some folks that try to get something in place like that, like 5 times maximum sold, 5 days you can call it. Like there was some things that failed, unfortunately. Now that may change in the future, but right now it looks like it's definitely going into effect on the date it's supposed to.
How do you think this affects two group of people, okay? The public traded lead gen companies that had their all-time high in 2020, and they're trying to live back up to that space, right? When they now have to even figure out how to squeeze revenue even harder. And then how do you think it affects the aggregators, the guys who are just reselling leads in the middle?
So the first scenario, I do think this is crazy intersection because you have this new rule change on the marketing side, but you do have macroeconomic trends favoring growth. Like the mortgage market is set to have pretty good, there's confidence that there's going to be 2 more rate drops at some point next year. The Fed, regardless of who was going to win the election, the Fed already came out and publicly said, right, that they're going to drop rates, which should help the housing market. There's a lot of people like myself. I bought my house 2 years ago. I was forced to get it at 7, and 7.25, right? But if rates go below 6, that's a substantial savings for me. I think there's a good amount of folks that have been on the sidelines as well that are ready to buy, but it was just not feasible at the current rates. So I think when mortgage rates drop, that will spur the mortgage growth for refi, which has always been big for direct to consumer. The auto insurance market's already had 2 back-to-back successful quarters, 2 or 3 successful quarters, right? And it's going to continue to grow. I think the macroeconomic trends favor more budgets for marketing, and that happens across all levels, as you know. And that happens at clicks, where the big carriers are buying clicks, agents are buying leads at record levels across all the agent bases. Inbound calls are still there, obviously, for some of the larger direct-to-consumer centers. So I think you'll continue to see the one area so you'll see the growth because of the macroeconomic demand and needs for some of these verticals. Same thing like home services, right? People are continuing to evolve in building out their homes and roofing, flooring, windows, big bounty items. So I don't see that slowing because the economy is saying it's going to keep growing. But the lead gen side for leads specifically, like leads where they've been what we call shared, where it's multiple buyers competing, I think you'll see more inbound calls, that's not TCPA related, that's inbound. You'll see more like direct traffic to your site, because that same thing, you're controlling the consumer experience going to your own flow. So I think you'll see more diversified approach. Insurance agents heavily lean on leads. And so, hopefully they have thought through already backup plans for not being so dependent, because I don't think the lead generators fully know what their volume is going to look like, right? They're experimenting with their flows. They're experimenting with, hey, does the consumer have to select each brand? Can I do a select all button? But you're going to not see a lot of this in place until we're closer to the deadline. And even from there, because the holidays are coming up, right? And so holidays are always a slowdown period between Thanksgiving and New Year's. So you'll see some of these changes really come into flows in January. And then once one of these big lead generators or community, figures out what's working, I think everybody will copy it. It just is going to take some time, and that's okay. We'll get through it. I've lived through, I try to use examples of multiple, whether it's vertical specific regulatory environment or, the federal level. I've lived through this in multiple times, and it's not doom and gloom. We're going to get through it. Now to your scenario too about the lead aggregator, the one that's not generating the lead, yeah, their business is unless they're working out a feed where they're able to produce the brand in real time from the publisher. There's some technologies out there that are doing that, like Active Prospect or Leadspedia, Leads Prosper, Bobberdo, all the lead plumbing tools. If you can match the brand in real time, the problem is that a lot of the aggregators, they're brokers, right? So they don't want to introduce their buyer because they don't want the publisher to circumvent them. So there's going to be an interesting dynamic there. If they want to leverage this technology, they got to understand that the publisher may just decide to go direct to the buyer.
Man, if we were in person, just sitting here drinking coffee or whatever, we could turn this into a 5-hour conversation.
Oh yeah, I've gone with my podcast. I've gone over an hour, and it's just like I don't want to cut it out, because I love the conversations. I love chatting through it. It's just, you said you can go, there's so much to discuss, and,
Yeah.
but it's a really interesting time, but I want everybody to know who's listening, from my perspective, I've gone through, you cannot stop consumers from shopping online. There's no doubt it's the highest form of advertising, and it's not even close, right? Like, obviously we just saw a massive amount of political spending through TV, but in the day-to-day life, right? Online digital ads are way, way, way ahead of from a budget perspective. And it will
Yeah.
continue that way. So you cannot stop consumers from shopping online. Do we need to have a better consumer experience? Absolutely. And we will. And we'll follow the new rules. But the lead generation community, this will bring everybody closer together. It will. It has to, because there's just too much at stake for everybody to fail. And so I think this will bring everybody closer together. And again, the consumer is going to win. Now, the consumer is going to win with less calls. Do they necessarily get the best deal? That's what we were just talked through. But I think we'll figure that out.
Interesting. I heard a stat yesterday that Progressive spent like 1.4 billion last quarter in advertising. And that's equalizing to like $6 billion a year in advertising. And I remember back in the day, maybe like a decade ago, when Geico made the biggest news that they spend 2 billion a year in advertising, and this is like their highest growth year. And I'm just like, and Progressive out here spending 6, and nobody's talking about it.
You become numb to it, because you're
Yeah.
just like, it's really weird. You're right. It's like it's crazy amounts of money, but those guys fuel the market, right? Because it happens, and same thing in mortgage too. It's just like, if Quicken Loans does not buy leads, then it kind of shrinks the advertising budgets for everybody. And Quicken knows that, right? Like, they know that if they buy more leads, then they're going to spur their competitors to come in and compete. And same thing, right? Progressive buys, they're the largest click buyer in the space, right? They fuel the click market. And so they know also that if they jump up, then their competitors going to follow. So, because then it lowers the cost of media when there's more competition, right? And they know their brand should help them persist on their conversion rate. So once the big buyers come back in and spend that kind of budget, it helps the overall ecosystem, because now there's more leads generated, there's more calls generated. It's always the 80-20 rule. Once the big gun comes in, that they're going to consume the lion's share of the budget, but you need that next tier and the medium tier in the insurance space, all the agents to really help. And then kind of the rising tide lifts all boats, right? The profitability's there for the lead generators. And you're seeing that in the earnings from a lot of the big folks that are obviously have benefited off of 2 great quarters in auto insurance.
I just love to be in like a C-suite office for all these auto insurance carriers. Once they saw Progressive earning call, some of them probably like listen to Progressive earning call live. And
Right.
when they heard
Yeah, of
that,
course.
we just spent 1.3 billion last quarter, I would love to see all of their reactions, because some of them are still reeling from the last 2 years of auto issue profitability losses, and they hear that number. Yeah.
Everybody, I mean, this because I saw you at a couple shows, right? Throughout the years, it's just like everybody was like, it's going to be next quarter. It's going to be next quarter. And it's just like, everybody was trying to time it, because they knew at some point, right? What goes up must come down. The same thing, right? It's like, you
Yeah.
had consecutive years of really bad earnings from the marketing budgets perspective, right? And you knew that the carriers were going to have to come back strong for customer acquisition, which they have massively. And so it's cyclical. That's what I talked about earlier. Just I've lived through 3 different mortgage booms, but then they crater, right? Like 3 different, 3 or 4 different auto insurance spikes. I mean, it's just the reality of how our society works in macroeconomic, conditions.
So many interesting things to chat on. What do you think about all the AI agent that's popping up everywhere these days?
It's exciting, right? Like, I think I think consumers a year ago were fearful of AI, right? There was a lot of doom and gloom almost, right? Like, and I think that there's still some of that, right? Like that, oh, AI is going to take over, human race is going to be gone, right? It's a reality. If you look back a year ago, that's where the discussions, right? Elon's gonna, ruin everything, all this other. And I think if you look now, I think as consumers every day are getting more comfortable with AI, whether using ChatGPT themselves or they're calling any different, call center that they need, whether it's CVS or, their airlines, and you're speaking to a tree that really sounds perfectly, well with your dialogue. And in a lot of instances, they make less errors than humans, because there's no emotion, there's no morale, it's flat, right? So I think it's great to see in our space as there has been technologies. If my former partner, Sean, has built out Symphony 42, right, where he's building the first AI lead generation, platform. It's really exciting to see an innovation within performance marketing. We haven't had that as much in the last decade, and I think we're starving for that. So I think as consumers continue to feel more comfortable with AI, obviously on a marketing perspective, it's going to continue to really help scale and be more efficient and help us rein, in on a better consumer experience. So I'm all for it. And I think it's just as consumers feel more comfortable with it, we're going to continue to grow it. So I love the innovation, whether it's I'm sure you have a better sense of it, like in the insurtech community, all the ways it's being used. But for me, like mainly I've seen it on the call center space, like for helping consumers go through calls, and whether it's outbound, inbound, qualification. Some are going all the way to like an application or a sale. It's pretty crazy.
The insurtech community is actually in a way bubbled away from the lead gen community. Like I go to like a lot of events, and the contact IO, the lead gen world or even affiliate marketing world are like two separate worlds from the insurtech community. Insurtech community have like 3 big events a year, and I don't see it touching. It's weird, and they should be touching every single day.
There was a point where when InsurTech started, Jay Weintraub, who is he founded LeadsCon, a good friend of mine, who's one of the pioneers of expansion of this trade show business. There was a beginning part where InsurTech, it did seem like, the performance marketing InsurTech community, there was a much more stronger overlap. But you're right, over time, they've kind of, maybe it's because post-pandemic, I mean, there's so many shows, right? Like, so you can't be everywhere. So whether you want to focus just specific on a vertical or industry or category, or you want to go broader, but a lot of the trade show businesses got crushed during the, years during the pandemic, that we've seen so many go out. There's one every week, right? It's like, it's nuts. So that may be part of it. I don't know, but yeah, it's weird. The insurtech community has gone further away for sure. I agree with you for sure on the lead gen side.
Yeah, because I think there's a lot of people building cool toys and cool gadgets, cool mouse traps, but they all really fail at grabbing the distribution. Like their funnel flow fails, if that makes sense.
Yeah.
They build a digital wallet where they build the Raider CRM flow, and where they fail connect is they fail to connect to the agent, the call center model, and that allowed them to do direct to consumer, and they fail to connect on this end on getting the traffic, getting the funnel flow. So they have like just a toy and doesn't touch either end.
Right. And I get that, because part of it is you're trying to build that nice new shiny toy, that you're trying to get that crazy multiple from an investor or an acquisition perspective. And, it seems like that always has fueled the insurtech community's mission, right? It's the sexy multiples and attractive, whereas lead generation, like typically it's constant growth year over year performance marketing, but you're just basically seeing average lead generator throw 20-30% margin, which is good, right? I mean, sometimes you can get higher, but it's just it's more of a volume play. And that not necessarily the case. So there's just this lack of competing. It used to maybe feel like there was more, connection between there, but it's distanced itself from kind of the objectives of what both are trying to fulfill.
maybe we can have a separate offline conversation, talk about how we can connect the world together.
Yeah, no, I always love my conversations with you, Jeff. You know that. So I appreciate you bringing me on, and I hope that this was valuable to your audience, and that I'm really happy for you that you're building out your show.
Well, Joey, I am looking forward to have you come on the show again soon. Maybe we'll do another catch up in 6 months. But thank you for coming on the show today. And I will get your intake form, and so our audience can follow you and connect with you.
Awesome. Yeah, thank you so much, Jeff. I do have I'll send you my link so that way anybody can join my newsletter or podcast. But I appreciate you having me on, Jeff. Thanks so much.